Hello and welcome. So, we're going to talk about something you bump into pretty much every day, right? Whether you're saving money, borrowing it, or just glancing at the news, we're talking about interest. It's this massive force that shapes our personal finances and really the entire world economy. But its story? Oh, it is way more complex and, believe it or not, controversial than you might think. So, let's dive into the surprising story behind the price of money.
You know, the word itself tells such a cool story. On one hand, interest is about curiosity, right? It's about what grabs our attention. But on the other hand, it's the fee you pay to borrow cash. So how in the world did we get from a simple human feeling to a cornerstone of global finance? Well, that's the journey we're on today. And it all starts by figuring out what we're really talking about.
At its core, financial interest is actually surprisingly simple. The easiest way to think about it is like a rental fee. But, instead of renting a car or an apartment, you're renting someone else's money for a little while.
So here's the crucial point. When a lender gives you money, they're taking a risk, right? They're also giving up the ability to use that money themselves. That's what economists call an opportunity cost. The interest they charge you is basically their payment for taking on that risk and for that lost opportunity. It's the price you pay to use their money now instead of having to wait.
Okay, so now that we know what it is, how does it actually work? Because the way interest gets calculated can make a world of difference. It can either be a powerful tool for building your wealth, or it can dig you into a really deep hole. Let's break down how this stuff actually builds up, for better or for worse.
Now, this slide right here is where things get really fascinating, because you see the immense power of compounding. Simple interest? It's straightforward. It's linear, just a flat fee on the original amount. But compound interest? Oh, that's where the magic or the real danger kicks in. It's interest earning its own interest. Think of it like a snowball rolling downhill. For savings, this is amazing. Your little snowball of savings picks up more snow. That's the interest. And it just gets bigger and bigger, faster and faster over time. But for debt, that same snowball is rolling right at you. A credit card balance doesn't just charge you interest on what you spent. It charges you interest on last month's interest and the month before that. This exponential growth is why a small debt can feel impossible to escape, and it's why Albert Einstein supposedly called compound interest the eighth wonder of the world.
Have you ever wondered how banks actually make their money? Well, this slide shows you the basic model, and it's kind of brilliant. They're basically the ultimate middleman. They pay you a tiny bit of interest to keep your money safe in a savings account. Then they turn right around and lend that exact same money to somebody else for a car loan or a mortgage at a much, much higher rate. That difference, that little gap they call the spread, well, that's their profit. Simple as that.
Which, of course, brings us to the next huge question. It feels like these numbers just kind of appear out of thin air, right? Are banks just allowed to charge whatever they feel like? Or is there some bigger force at play here, setting the tone for the entire economy?
Well, the answer lies with an institution that acts like an unseen conductor of the whole economic orchestra, the central bank. And here in the U.S., that means we're talking about the Federal Reserve.
Now, the Fed doesn't directly set the rate on your car loan or your mortgage. But what it does do is set the master dial, the federal funds rate. That's the interest rate that banks charge each other for super short-term loans. And that one single number creates this massive ripple effect. When the Fed raises its rate, it's trying to cool down the economy and fight inflation by making it more expensive for everyone to borrow money. And when it lowers the rate, it's trying to fire things up by making it cheaper to borrow and invest. Either way, those costs or savings get passed from bank to bank, and eventually they land right on your doorstep, influencing pretty much every loan you can imagine.
So, while the Fed basically sets the stage, they aren't the only ones in the play. The final rate you get on a loan is really like a cocktail of different ingredients. You've got the Fed's policy, you've got what other banks are charging, you've got the overall health of the economy, and of course, a huge part of it is your own personal financial situation, your credit score, your history with debt, all of that.
Okay, so far, this all sounds pretty normal, right? Just a standard part of modern economics. But here's the twist in the story. For thousands of years, the entire idea of charging interest wasn't just debated, it was considered one of the worst sins a person could possibly commit.
And this is a really important thing to get straight. When we hear the word usury today, we think of like loan sharks charging crazy predatory rates. But historically, usury meant charging any interest at all. 1%, 0.5%, it made no difference. The act itself was seen as fundamentally immoral.
And this was not some fringe belief, okay? We're talking about the heavy hitters. The great philosopher Aristotle argued that money is sterile. It can't reproduce on its own, so making money from money was just unnatural. For centuries, the Christian church completely agreed. Multiple church councils banned it, first for priests and then for everybody. It was taken so seriously that people known for lending money were denied a Christian burial, and just believing it was okay to charge interest was officially declared a heresy. Wild.
I mean, this quote just stops you in your tracks. Cicero is telling a story about Cato the Elder, a really famous Roman statesman. When someone asked him what he thought about usury, he didn't give some complicated economic answer. He just shot back, "What do you think of murder?" That's how bad it was. It was seen as literally profiting from someone else's suffering.
And this slide just perfectly captures the total 180-degree flip in thinking. What was once seen as a terrible sin is now the literal engine of our economy. What was condemned by the world's greatest thinkers is now taught as gospel in every business school. The practice of charging interest went from being totally forbidden to just being regulated. It's a staggering change.
So where does all this leave us? We've looked at how interest works, how it's controlled, and how, for most of history, it was morally condemned. It's pretty clear that interest is not just some simple, neutral financial tool.
This is the core tension right here. On the one hand, the ability to earn interest encourages people to lend their money, and that lending fuels everything from a small business startup to huge public works projects. It powers growth and innovation. But on the other hand, that long, dark history of moral condemnation isn't just some ancient curiosity. The fear was always that interest, by its very nature, exploits people's needs and traps them in a cycle of debt.
And so that leaves us with one final question to think about. Is interest a fair price to pay for the opportunity to use money that you don't have yet? Or, deep down, is it still what those ancient philosophers were so afraid of? A penalty charged to people precisely because they are in need? The real answer is probably somewhere in the middle, but it's a question worth asking yourself every time you look at a loan statement or a savings account.